Hello and welcome to the Phoenix Trading Academy. I am the Nomadic Trader, and this video is the presentation for the PDF which I've released within the community, and that is the trade checklist for the ICT 2022 mentorship program teachings. And what I'm going to do is I'm going to give you a run through exactly how to use the PDF and the concepts within it. And I'm operating on the basic assumption that you already have an understanding of the teachings. If you don't, please refer back to ICT's playlist where he's actually got the teachings in there, and or the teachings that I also provide within my channel as well. So without further ado, what I'm going to do is bring up the PDF. So let's have a quick look here. Here we go. So first of all, we'll start at the top, nice and simple, trade checklist, and then I'll run you through some of the details. So what I would advise is you to print one of these for each day of the week. And if you're trading both sessions, you may want to print a couple. The reason why I actually suggest that you print these and you actually fill them out per trade is to improve on your accountability. So something that I've always experienced, and I still do suffer with it now, is the accountability and also revenge trading. So you can see that I've actually incorporated that within this plan. So when you've got these printed on your desk, and you have to, as a rule, fill them in for each trade that you take. You're filling in what instrument it is. So for me, it would be the S&P 500 because that's all I trade. There's the time and the date of the entry of the trade. There's the day of week, which will also help you when you are back testing and cataloging in your journal for the power of 3 for the week where the weekly reversal occurred. Daily profile, and within the daily profile, you are looking to include just a brief sort of highlight or highline overview of, was it within a trend environment? Were we within consolidation? Because that is also going to determine how you enter the market and where you look to take profit objectives. Was it an AM or a PM trade? And these are the times here. So this is actually fine-tuned timings here. This here is EST. And then below, we've actually got the GMT time. This is fine-tuned for the ENDS series, which is actually based off a slight variation of the model, which is more in tune with actually just using a small position sort of target and stop loss. What we're anticipating is for the move to have already unfolded here, and what that does is it actually narrows down the window for error. However, if you wanted to stick with the standard trading times, then you can do, and I won't cover those here because it would be unfair for me to give you all the information, because I do want you to be able to take this and to do some back testing on it yourself. And also your emotional state. Were you confident? Were you fearful? Were you feeling greedy? And this is another prompt for me. Am I looking at revenge trading and getting back in to the market as soon as I've actually taken a loss? So entry criteria, the weekly expansion and the power of 3 on the weekly candle, the DDP, which is the daily directional prediction, which is another term for the daily bias. And if you're not au fait and you're not confident with this, then please refer back to my daily bias video. The 15-minute candle needs to be trading at or off of the 1 hour PD array. And the PD array that I teach is a fair value gap or an old high or an old low. There needs to be a raid on liquidity, which will be the opposing liquidity of your trade, or at least the opposing direction of your trade, which this is also the Judas swing. There needs to be, following a raid on the liquidity, a displacement. Then you need a market structure shift, and then you're looking for a 5, 3, or a 1 minute fair value gap for entry with a maximum risk of 1%. When we trade, I've covered those already, but we're actually trading around the medium and high impact news, and that will actually be the driver for the volatility coming into the market. And then when we don't trade when there's really big firework news. Non-farm payroll, you should already know this, but we don't actually trade from Wednesday afternoon up to the non-farm payroll Friday. And then FOMC, we don't really want to be trading an hour either side, and the same with any Fed or sort of Chair Powell announcements as well. We need to be really mindful of the really big drivers of news. We don't trade on low volatility, so that things like bank holidays, whether that's in the US or whether that's in London. Asia really doesn't count because the Asian range is not directly involved in the reasons for entry. And I don't trade directly after taking a loss unless I'm absolutely sure that I can come back in and fill in another one of these to ensure that I was a little bit early, I jumped the gun for whatever reason, and usually for me that's fear of missing out. I've entered the market too soon, and the market then develops the full model, and I can actually see that with clarity, then I will actually do that. And then a rule for this here, I'm going to introduce this. It's not just a fancy little clip art drawing. This actually limits me to 6 shots for a week of trading. So there's 5 days, obviously, in a trading week, Monday to Friday, unless you're trading crypto. So there's 6 shots here. So within this revolver, I afford myself 6 opportunities, 6 trades maximum per week. And that actually limits over trading. It also helps with your emotional state of psychology, and it also reduces the risk of me revenge trading. So rules of engagement: we trade after high and medium impact news, and we use the volatility to our advantage. When we are taking short trades, we are looking to engage the market only after a buy side liquidity raid has occurred. And that's the opposite when we're taking longs. After a significant short setup has occurred, but the draw on liquidity is yet to be reached, any new fair value gap on the 1 minute time frame can be traded, providing that it meets your risk profile. And the risk profile for me is actually 2 to 1. After a significant long setup has occurred, we can actually do the same, but in reverse. We never risk more than 1% on any given trade. We avoid revenge trading, and the liquidity, where I'm actually referring to that on draw of liquidity as well as the raid on liquidity here. That is equal highs and lows, old highs and lows, and fair value gaps. And then also a little Brucey bonus, we don't enter at existing equal highs or equal lows unless we are entering the market with confidence after a 3 drives pattern and that there is SMT divergence across the different indexes, which I'm not going to cover in this video. And then there's just the links to the video. Obviously, recording this video, once it's uploaded, I'll put that link in. So with this in mind, so the instrument in this example will be the S&P 500, and then the weekly expansion is the first thing that we need to work out. So what I've done is, the time of recording, this is the 2nd of October 2022, and I've actually gone back using the replay to delete the up-to-date weekly candle here. So given this price action, this here is the draw on liquidity, because that is your sell side liquidity. Okay, this is an old low on the weekly and the daily time frame. And then if we go down to the daily time frame, this is what that looks like. So this is the drawn liquidity. We're very heavy. This is an extended run down, so we are anticipating some form of a pullback, whether that's before or after we've tagged this. But the overall weekly expansion is to the downside, so that gives us a bearish bias for the week. So we don't stray from that until obviously you reach the point where you are hitting consistency and you are hitting long-term profitability. I suggest that you don't actually do counter trend or bias trading. So the DDP on this, so this was actually Friday's trading. So let's fast forward one day. Okay, so when we have a look at the market, I'll switch my little indicators on. So these are fair value gaps. So what we've actually done is we've created another fair value gap here on the daily time frame. So this is your bullish PD array low hanging fruit, daily bearish fair value gap. So this was Monday of last week's trading. So what you're going to notice, I'll give you a quick run through. And what we actually did is we created an outside day here. So we've actually cleared liquidity on both sides of the market. We did the same again. And now we're starting to engineer liquidity. We've taken this here. So on the monthly time frame, we actually have this fair value gap. And I do cover this in more detail in my weekly videos, as well as the daily bias. So I won't go into that here. So we've taken the sell side liquidity on these two candles. We are looking like we're forming a swing low here, which would be confirmed with a follow through on candle 3. So 1, 2, and then we need a right higher low here. We've traded into that daily fair value gap. So we've actually got now the buy side liquidity. So we're looking, is this going to pair with sell side liquidity again, or is it going to continue higher to fill in some of this imbalance? Well, we've created a swing high now, and we've created a swing low. So we're in a unique position. And then the end of the week's trading, we actually created a pivot here, and then we traded down into this monthly bullish fair value gap. So that's another the replay. And what I'll do is, rather than spoil all of this, so if we have this here for last week's trading, so the end of last week was the 23rd. Here we go. So I'll change the color of this because I know you won't be able to see that otherwise. Okay, so this is actually the week's profile, and for the most part it actually looks like it's consolidation. So what we've actually been doing there is we've been clearing the liquidity on both sides of the market because we were heading towards a higher time frame discount PD array, and that was actually this monthly fair value gap down here. So as it is here, we can't really make sense of it. We just haven't got any perspective on time. So I use this indicator here, and this line is the New York midnight open time. This horizontal line here is the New York midnight open price. And then I've got the morning session mapped out in blue here, with the lunch no trade hour in red. And then I've got the afternoon trading session here. So this is New York trading session split up into the morning and the afternoon. And you should already be au fait with the time, so I won't go into any more detail there. So if we remember the model, so we go back to the PDF. So we're looking to take a short trade between 9:30 and 11:30 in the morning Eastern Standard Time within this column, and we're looking at going short within this here. and we have gone short from here down. However, there would have been no news in here, so we'd have been content with this move. So this would have been a successful trade. This would have been a successful trade. This was late in the afternoon on Wednesday, and we were actually trading right towards the close, and we didn't have an entry at that time. So this would have been a failed or a missed opportunity to get in short. Obviously, none of this price action existed, so we didn't know if we were going to continue to close in this gap. And then we've actually got an OTE here. So having a look there up until Friday, we've had 3 potential opportunities. And then also one here as well on Friday, which would have been another opportunity to get short. So we've got 4 opportunities in total. And let's have a look. So the weekly expansion is to the downside. The DDP is going to be short, okay, because we've actually come back up and we've tapped this fair value gap here. Okay, sorry, this would have actually created the fair value gap. However, what we've done is we've actually traded back up into this fair value gap and we haven't taken the high. So the model is we need a 15-minute candle trading at a 1-hour PD array. So if we go to the 1-hour time frame, there's our weekly trading. And I said that the PD arrays were old highs and lows as well as fair value gaps. So we don't have any fair value gaps here. However, we have an old high. We've got an old high here as well as that daily fair value gap, which was created from the high of this candle. And then we don't actually have a raid on buy side liquidity here. And this was 3 o'clock in the afternoon. So what I will do is I'll draw that on and we can back test that. Okay, so, and then Friday, nothing obvious on the 1-hour time frame. Back down to the 15-minute time frame. So as per the entry criteria, we know that this is actually a 1-hour PD array because it's an old high. It's trading back up into this 15-minute fair value gap, and then we come back below the range that was created on the high of this candle. So tick that one because we are bearish. Tick that one because we would have been watching the daily candle setup to create your DDP. Tick that one because your 15-minute time frame was trading at a 1-hour PD array. The 1 hour is obviously the higher time frame to the 15-minute and below time frames. The raid on liquidity is we've actually taken this, and also if you think about the liquidity and the raids, this was the London high. When we traded into New York, we actually took out the London highs, and then we've got relative equal lows here. So where we see this, we know that this is induced liquidity. We've traded higher into that high time frame PD array, so we can tick all of those. And then we're looking for displacement back below this range. We've taken the liquidity from the London highs, and then we've actually left that here. So everybody that's long here, or everybody that was short here, you've got people entering long, and you've got people stop losses buying back the market here at a loss that went short here. So let's go down to the 5-minute time frame. Back to Monday's trading. So we've broken that, we've come back down to retest it, and then we've actually failed here. But on the 5-minute time frame, there is no fair value gap on this leg. However, where we've actually got this swing low which has been violated to the downside, we've now got a fair value gap. Apologies, we don't have a fair value gap because of the low of this candle is closing in that range, so we need to go lower. So the way that you would actually approach this is during your kill zone or your trading time, so 9:30 to 11:30, or the standard time would be 8:30 until 12. So there's 8:30 and there's 12. So what we're looking for is we're actually looking for a shift in market structure. So we've got a swing low here. We've had a shift in market structure, but we've not had a fair value gap. Plus we haven't seen any displacement back within this range. We have a shift or a break in market structure now because we've got two swing lows. Okay, there's one, there's two. And then we've had a trade back up, but there's no fair value gap. So go to the 1 minute time frame. And we see that here. So consolidation, a shift lower, and then this would be the displacement. We're back underneath the old high, which is it's a failure move, failure swing high, and then this would have been the trade. So we've got the weekly expansion, the DDP, 15-minute, we nose traded into a 1 hour because we've back tested that. We've had a raid on liquidity. We've seen the displacement. We also now have the shift in market structure, nice and simple to see. Then we've got a 1 minute fair value gap entry, and then we're looking at placing the trade. So when we scroll out, we've taken the London highs, we've traded into a higher PD array, and this now is induced sell side liquidity. So this would have been our full-time, or sorry, I should say our long-term full objective for take profit. And in order to get the internal range liquidity, there's the low to the high for the dealing range, and you're looking at pairing that with discount. So that would have been your first target, 2.2%. That would have been target number 2 for 3.6%, and then the long-term full target would have been just below there. You could have probably just eked out a 6% reward. And I'll be honest, if you're pulling 6% out in one trade, which took you from entry here to here, would have been 1 hour 33 minutes to get 6%. You imagine now the confidence that that's going to give you, and that was Tuesday's trading. So on Tuesday, you've just pulled 6% out of the market, and imagine the confidence that that would have given you. So just notice here that we've got this high, which would have been Tokyo, and then so this here, let me go up to the 1 hour time frame. Okay, yeah, so because I've actually got this drawn on from the beginning of the week, I've actually missed the opportunity from Monday. So this here, my apologies, would have been opportunity number 1. So you've got the Asian range from here to here. And what we've done is as soon as London open occurs, okay, 2 a.m. in Eastern Standard Time, which is 7 a.m. GMT, we've taken the sell side liquidity, which has actually got all this induced liquidity, and then we've traded back up higher. And then this here, if I just highlight that, would have actually been our first opportunity. You'll just have to live with me going back and doing it second trade before the first trade, because I'm not starting this video again. Here we go. So from the 15-minute time frame, there's your swing low, clear displacement here, and then we've got a lower fair value gap and a higher fair value gap. And the rules are, we enter on the lower fair value gap, and the way I would do that is there's the high to the low, and we would be entering within a premium, so I would have that on the 50%. That also helps with your risk to reward. You need to permit the trade to come back up and fill in this fair value gap, so you could have it at the top of the high of this candle. So your entry would be on the lower hanging fruit. However, your stop loss, you would permit price to trade up higher into that one. And then again, there's the dealing range low to the high. Target number one would be a PD array within a discount, which is that there for 1.3%. And then target number two would have been here for 1.8%, and then target number three would have been 3.2. So you got a maximum here of 3.2% within a period of time of 1 hour 15 minutes. So you got 3.2% on Monday. So by Tuesday you're almost up an entire 10%, and that's based off of 1% risk. So all of this criteria was met. We haven't done any revenge trading. We're not trading at uncertain volatility times. There were no bank holidays, and for shortening the length of this video, these entries were at medium and high impact news. So I'm not going to continue to do the rest of the week because it's just rinse and repeat. And hopefully you can see the value in ticking off these 1 shot, 2 shots, leaves you 4 shots for the rest of the week. And we've had exactly the same here. So this is the reason why Michael has suggested that we shift and tune the entry to 9:30, because that's the volatility open, because look what we've got here. So we've got London highs, which were taken at 8:30. So this would have actually given you reason for entry, and we'd have taken a loss here. So with that in mind, this is why I fine-tuned this to 9:30 a.m. because that's 20 past 10. So that one still gets it. And this was actually a London open session. So the reason why actually I wouldn't have seen this as an opportunity is because it doesn't actually fall within the guidelines of the trade time. But I guess this is just a good example of how you can trade the London Open. If you are in that part of the world where this is actually better for you, go back and back test this because it does occur. So that's the video. Hopefully that was short enough for you to stay tuned in. I will include the link to this PDF in the description. It will also be available in the Discord group, so please head on over there as well. And as always, I'd like to credit ICT for his teachings that he's made available to us within the community. I'd like to thank you for your time, and also if you've got any feedback, positive or constructive, please put that within the comments section below. And to try and help me get the channel out there, I'm actually rapidly approaching 1,500 subscribers now, which isn't a lot, but that's a milestone for me. I do want to help as many traders as possible to bring together their knowledge and also to get them over the line in terms of consistently as well. So please share this video within your communities and give me a thumbs up and comment below. Thank you.